Hello all, hopefully people joining now. Just say I'm Paul Norman, Managing Editor, CoStar News. Delighted to be here with a great panel to discuss the topic, searching for yield in a low yield environment. How does real estate stack up for investors? Before introducing the panel, just to set the scene that the scene I've been given to set here. Generating genuine value for an investor remains today's #1 challenge, especially in a COVID world. The 60-40 balanced preferred portfolio between equities and bonds is not working, this panel will suggest, and as valuable as it is, diversification, even diversification into the right sectors, isn't enough to create a defensive portfolio that can withstand economic storms such as the one we're in now. What investors need is transparency and detail. So here we're going to discuss how commercial real estate as an asset class continues to perform strongly, offering investors consistent returns. We're going to look at the different sectors that are performing well and that aren't, and how investors can access this sector without the fear of gating, high fees, inaccurate asset valuations, and so on. So to introduce our panel, we have Roger Clarke, Managing Director and Head of Capital Markets, IPSX. Roger has extensive experience in corporate transactions, particularly in equity capital markets, but also in M&A and restructuring with a specific sector focus on real estate. He spent 20 years working in the European investment banking industry, including roles at NM Rothschild, Dresdner, Kleinwort, Wasserstein, JP Morgan, Cazenove, and Stifel Nicholas, as well as undertaking a secondment to the UK takeover panel. We also have Charlie Foster, Managing Director, Head of Real Estate Investment Banking, RBC Capital Markets Europe. Charlie leads RBC Capital Markets real estate franchise within its global investment banking activity in Europe, and joined RBC in September 2018 with 20 years experience in the property sector. He's also been head of real estate at Canaccord Genuity, which he joined in 2014. And then finally we have Noel Manns, chairman of the Pollen Estate. He was a co-founder, particularly well known as a co-founder of Europa Capital, pan-European real estate fund manager. Previously a shareholding director at Richard Ellis, which of course is now CBRE, and a director of a Bank of England subsidiary. He's also a former member of the boards of INREV and the Investment Property Forum, and is an advisor to the Diocese of London on property matters, and many, many more things. To begin with, and just to say, there's a Q&A and a chat box. Please use the Q&A box to send in questions. I'm going to kick off with a few questions to set the scene, and then hopefully we'll be able to get questions from all the people tuning in as well, and I'll try to get to them over the next hour or so, or maybe less, maybe a bit more. So to begin with, some context. The new normals seems to be a long-term low interest rate, which is raising questions for people. Where do they find yield for investors? I wonder if I just ask broadly the panel, what's happening globally for investors and where real estate fits into this picture, and maybe come to Charlie there.
Yeah, thanks very much, Paul, and good afternoon, everyone. Great to be here, and look forward to discussing this topic and batting some of the questions backwards and forwards. I think the low interest rate environment post the financial crisis has really shone a light on the asset-backed, yield-led total return attractions of real assets, which is an increasingly broad church, and real estate being a key component of it has also become an increasingly broad church as the traditional food groups of retail, office, and what used to be called industrial have expanded to include many more of the still often referred to as alternative sectors that have in common a much higher degree of operational involvement. Usually a look through straight to the underlying operating businesses, and that, I think, is a key area of where the real estate markets globally are now, wanting to have real confidence in being able to see the underlying trading performance of the businesses that are paying the rent, whether it's via a traditional lease structure or something far more operationally flexible.
Okay, and we'll come on to a lot of that in a bit. Noel, what are you seeing in the broader investment story and real estate's position here?
Well, everybody's looking for yield, and there's very little yield in any market. I think it was Larry Fink in his New Year's address to us all said that we're now in the new nominal. Nominal rate's going to stay pretty well where they are for a long time. I thought it was quite a good catchphrase, which means that they're going to stay low. I mean, our governments are going to be pretty relaxed about inflation creeping up a bit, particularly to pay off some of the debts. And therefore, this is quite good for risk assets like real estate. So I think, real estate's got an investment proposition due to low interest rates, but also it offers yield. And there's very few places you can get yield. And a lot of people need yield. I mean, maybe come on to talk about the differences in types of people and what they want, but a lot of people need some yield. And I think the final death knell in the UK for the private investor was National Savings and Investments, which is a sort of bellwether British kind of account you might put your money in. And it was at 1.1%, if you put in 10,000, whatever it was, for a while. Everybody else was at 0.1%, and of course, eventually they went to 0.1%. And you could see the howls in the papers about this. But actually, it was just a reality. We should be really paying to have bank accounts, not getting anything at all. So we've got to find yield somewhere, and real estate's a chance.
Okay, Roger, anything to add about that broader picture before we go into why real estate is such a good thing to consider?
Well, not much new. I think it's interesting this week that we see a little bit of a sell-off, particularly in the US Treasury market. I think it's quite interesting. It's quite an interesting indicator that after a year of being worrying about the economy being closed globally, it shows that investors have been very, very, very quick to start worrying about the old thing they used to worry about, being inflation. And that's why the very merest hint of a reopening has seen bonds sell off. I think that's probably a mistake. And I think that the need to find an alternative to fixed income is going to continue to be a really important theme in capital markets. Okay, so now just asking the question, why real estate as an asset class for investors? And like within that, I think we were talking a while ago about this. Real estate does seem to get overlooked maybe as an asset class in this sort of broader picture. Just ask you a bit about why that is as well, and maybe come to Noel first on that topic.
You're right. And it's rather frustrating. It's been frustrating all my career, really. I've just recently I've been through a couple of pitches where organisations where I'm on the board, and we've had people pitching to us the mandate to manage our money. And in both cases, real estate's sort of was only mentioned because I'm in the room almost, and largely looking at private equity, which has certainly got a place, but it's very liquid. You've got equities, bonds still. I mean, I don't know where bonds go, but they can't go any lower in terms of interest rates. Therefore, there must be a sell-off in bonds, and at some point that'll be a problem. And then real estate sort of tucked at the end, admittedly, with some other alternatives such as infrastructure, which I think is interesting and good to have alongside us as a mutual friend, really. But the big managers just don't offer the product, and if they do, they offer either REITs, which are really, very similar to everything else in the current structure, an equity more than a property, and then or they offer private equity funds or gated funds now, which don't really suit people. So the manager, the big houses don't really, not many of them have an effective real estate offer, and that's an opportunity for others.
What do you say when it comes around to you in the room and when they see you there about real estate?
I'm not scary. I just send that asking the question. But honestly, you have to say, right. Well, how would real estate improve the lack of volatility in this portfolio, diversity of returns, and so on and so forth? And please, can you plot that? And usually it helps, and frankly, as we all know. But a lot of real estate they're offering you it doesn't help much, because it's just large equities, global equities, rather than real estate. If they have to invest in real estate, but the story is lost in the equity. Yeah.
Okay, Roger, why real estate as an asset class for investors?
Well, I'm always struck whenever I have a conversation with anyone or hear commentators talking about this 60-40 issue. I think what we're all saying here is not controversial or revelatory. The fact that a quarter of all government bonds yield less than zero is plain for everyone to see. What I think is surprising is that whenever people talk about where to go as an alternative, and I'm just sort of really repeating what Noel said, I hear people talk about hedge funds, private equity and infrastructure, but very, very rarely real estate. And I think part of the reason for that is that real estate is a difficult asset class to own and manage yourself. I think Noel is absolutely right that listed REITs have some terrible drawbacks in terms of just you know, we have seen, to be fair, over recent years an incredibly unusual correlation between all asset classes in pretty much all markets. And you know, you only need to switch on Bloomberg in the morning and find out whether it's a risk off day or a risk on day, and you know which direction everything's going to go in. Bonkers, really, isn't it? And I think that's part of the problem for real estate, is it's always been regarded as a little bit hard to get your hands on. I think REITs, big REITs, the problem there has been largely driven by regulators. I think we've seen since the global financial crisis 12 years ago that a kind of quasi-religious lust for liquidity has replaced everything else. And that means that inevitably the quote-unquote successful popular REITs have been the bigger ones. And that sees them go into general indices, and that sees them fall prey to program trading, and that sees their value get slightly disconnected from their underlying assets.
Yeah.
At times. So yeah, I think that's the problem with real estate. It's hard to access.
Paul, can I just, I scribbled down a direct answer to the question, which neither of us have given really, but I wrote down why real estate asset class: repeatable contracted income, inflation hedge over longer term, reacts to economic cycles of the lag, not directly correlated to equities, tangible and can be used as security for loans. That's my little world of real estate, but those are 5 reasons to do real estate.
Well, I hope everyone was taking. By the way, you don't have to take notes. By the way, this is recorded, and I think you can all. I'm going to tell you about it. They can all watch that later. But that was very helpful, Noel. Charlie, is there something you'd want to add to that? Really, that was good summation there, I guess. But yeah.
Yeah, and I perhaps I might present a kind of glass half full perspective, because in the world that we see, there's a huge amount of activity, which is great from our point of view as an investment bank in the world of global real estate, and my day-to-day space is across Europe, as we see lots of clients across the public and private markets with increasing amounts of money raised in their funds to allocate to the sector across a variety of different strategies, from opportunistic rates of return, which tends to be less public markets relevant, through to core and core plus, which often does straddle a dividend-led return from the public markets. So I think there is strong and growing demand for the asset class. The route to transact remains misunderstood and perceived as overly complicated, I think, by lots of would-be investors, and the fact that there are more venues or mediums through which you can access the asset class, I think is always going to be a good thing. But I think the money that is coming into the sector is being attracted by all of the criteria that Noel and Roger have spoken to, and is likely to continue to keep being allocated as we remain in this lower for longer interest rate environment. And whilst my FX colleagues and fixed income colleagues have been on their toes over the first 2 days of this week, what with the movements in the fixed income global markets, these are still nominal movements, and the demand for yield backed by an asset, I think we're all expecting, will remain very strong.
Okay, now I just want to, we'll come back to some of the ways of accessing real estate, but one of the stories of, for the last several years has been, there's been a giant amount of money wanting real estate, but it's a very kind of specific, safe, core type of real estate typically. So the money's there, but it's for a very specific type of real estate, I guess. And I just wanted to circle into, go into which sectors does the panel consider are performing most strongly? And as we exit, well, I say that, I'm not presuming this, but as we come out of COVID, which are going to bounce back the most strong? And yeah, come to Roger first, just going into the sectors, basically.
Oh, well, I'm very grateful that you came to me first, because I'm sure that we're all going to agree violently.
Yes.
We said. So, I mean, look, the sectors that, and I think it's worth pointing out that what I'm about to say, it reflects a lot what's happened in the last 12 months. But importantly, these trends were there already. We were already moving towards, and it's just been accelerated towards I remember when I was still an investment banker, Paul, that we used to talk about trying to target clients who were not necessarily in sectors, but were doing things which could not be disintermediated by the internet. Now, clearly, retail can and has been, not all of it forever, but it has in the short term. And clearly, logistics, and then more recently, smaller urban logistics, have benefited from the big move towards online retailing. But I think it's other things as well. And I think it was referenced earlier on that large areas of the market that used to be called alternatives, as this kind of weird backwater, has now been seen to be very lifestyle dependent, whether it's student accommodation, whether it's medical property, whether it's self-storage. These are all things which are, Noel will disagree with me, there may be some, but they're not in the traditional way economically cyclical. You are always going to go to university, and actually one of the things that the student sector prides itself on is that repeatedly throughout downturns, if anything, attendance at university rises. So things which are perhaps cycle proof, that are very much driven by lifestyle needs rather than choices, they start to do what Noel was referring to earlier on. They produce resilient, predictable long-term income streams, and they're popular.
Yeah, I mean, just interesting with student accommodation. There was a view as the pandemic got underway that would be particularly hit by people realizing, oh, I can just do my courses online, forever. But I don't know. That doesn't seem to be your view there, Roger.
Not in the long term. I mean, clearly, I'm glad I didn't buy a lot of student accommodation 12 months ago, because on a 12-month view, that wouldn't have done terribly well. But on a 12-year view, I guess it probably will.
Yeah. And then, on the same theme, Noel, is there other, is that your view? I mean, obviously industrial red hot sector at the moment, and you so life sciences, but are there particular ones that you really favor or don't?
Well, I mean, if you're on a sort of value-add opportunity investor, which I was for most of my career until I became more normal, those sort of those things that have been hit, places where you aggregate, have to get together, like leisure and so on, have really been hit, retail, and there must be some opportunities in there. For that investor, for the income investor, the long-term, need regular income investor. I love it. I've always liked industrial. It's simple to build. It doesn't date and go out of fashion very quickly. A portal frame is a portal frame for 50 years. And you can play around inside it, move it around very easy, and it'll let different types of people. And it kind of works, and ironically, it's now worth more than better yields than retail. But I think that stands for retail warehousing as well. I mean, basically, one of the big problems we've got at the moment is people don't want to get on public transport and go anywhere, city centres, etc. So retail warehousing offers a car park at the front door for the retail buyer, and a docking bay at the back for the last mile delivery. I just, it's almost made for this pandemic, really. So I think that's pretty interesting. And the other thing, I mean, and if you look at the the rental receipts, it's been really interesting to see who pays the rent and who doesn't the last while, Anyway, maybe you're lucky in retail if you're between 50 or 60% of your portfolio actually pay. Offices probably 80-85. Industrials bang on. I mean, it's 98%. Residential's the same. You should have residential in portfolio. That's people on the whole pay their rent where they live. And obviously, offices, are another potential recovery stock in certain areas. So I think you know, there couldn't be a better test of whether the income's good, given the changing world we live in, than the last year. But I think what's a little bit interesting, I should just say now, is that, you know, a lot of people have been drawing down deposits, which are held in, you know, as part of the lease arrangements, and those are being paying the rent from those, and those are not repeatable unless they're recharged. So one thing to look at when you're analysing companies or indeed assets is to find out, you know, what deposits have been used and what are still available to pay the rent if there's a miss of rent. And I suspect this next year will have another year of difficulty because some of those deposits won't be there to meet the gap. But
yeah,
they'll improve. So.
Absolutely. And Charlie, when you're obviously looking at lending across the real estate space, I mean, you're obviously thinking hard about what you should be lending to. Which stand out for you as the you know, bulletproof ones, and which are really in difficulty?
Yeah, look, it's a great question, and I should kind of declare from the outset that I'm not directly responsible for the lending part of the capital markets business at RBC. The investment bank, you know, sits separate, albeit, you know, very closely aligned to that.
Yeah.
And where the balance sheet is most interested is a combination of the underlying real estate fundamentals and the counterparty confidence we have in the borrowers that we would be lending to. So we don't filter by which asset classes or indeed regions are good or bad. It's very much on a case by case basis according to the underlying, you know, strategy in place with regards to that assets, that portfolio, or that corporate unsecured position. And I think it comes back to that point of real estate having become recognised as less of an alternative when it was, I think, often perceived as separate to the mainstream asset classes, and being actually much more closely aligned, because the performance of any business that occupies real estate on a leasehold basis and therefore pays a rent, you know, unsurprisingly, has a direct bearing on the reliability of that rent being paid, almost irrespective of the lease term, as we've found with the eviction moratoriums and the impact that has had on rent collection levels. So looking through to the underlying tenants via whatever structure you have in place through an investment manager or PLC is how we look at things. Okay.
I'm already getting some questions coming in now, and I think the first two are kind of fit into where I was moving next, which was, you know, I'll read them out, but what choices do investors have when thinking about accessing the sector? And we're just talking through the options around funds, REITs, the listed sector, but a couple of questions have come in. No one disputes the logic of securitized real estate, but the regulatory hurdles to gain access for the retail investor remain high. Does the panel see this changing anytime soon? And then we also have the arrogance of the real estate financial services industry in allowing investors to manage their own money is breathtaking. Will the UK funds regime review make any difference to this, and who are the disruptors? So quite big questions there. Well, I guess I just wanted to come with them in mind, come to you about what choices investors have when thinking about accessing the sector. What should they be looking at? And probably come to Roger quickly first then. Well, not quickly, please talk as long as you'd like.
Yeah. So I don't know whether that, I'm looking at that written question, whether it's a typo, that whether the questioner really thinks it's arrogance of the industry to allow.
Yeah, maybe not. You're right. Yeah, the other way around. Yeah.
If someone does think that's arrogant, I think that's a bit breathtaking. I think the fact is that is the direction of travel in the world, that investors want more control. They want control over what they buy. They want the transparency Charlie was just referring to. They want to be able to understand tenancy schedules. I think that, I mean, and clearly that is something that we at IPSX are trying to also open up to retail investors as well, so that they have this same access to information and data that professional investors have. I don't regard that as a bad thing. I think that is only a good thing. do I envisage the current funds industry review making any regulatory changes? Possibly not specifically the review of the asset holding companies and the fund management industry, but there is, at the same time, there's so much going on at the moment. There is, at the same time, the Hill review, which is looking at, in particular, IPO markets and the competitiveness of London as generally a capital market rather than just a fund management industry base. And I think perhaps there, I mean, we've seen just this week that the three sort of leading lights of the retail stockbroking industry, the CEOs of Hargreaves Lansdown, AJ Bell and Interactive Investor, wrote an open letter to the Times yesterday calling for retail investors to be given more access to wholesale capital markets transactions. I don't think that would be a bad thing. Again, I just fundamentally disagree with the question. I don't think it's arrogant of the financial services industry or the real estate industry to allow investors to have some control over their own capital. So yeah, I hope it will change. Okay, just coming on to that, what choices do investors have when thinking about accessing the sector? Obviously, you have a very specific and interesting proposal, your exchange you're working on at the moment, but just I'll ask you about that. We think what we're doing provides that sort of transparency at single asset level. It provides liquidity and regulation because we are a recognized investment exchange. We're a stock exchange governed by the same sort of rules as all other stock exchanges in London. So we sit very nicely in between the open-ended fund structure, which, as Noel mentioned earlier on, is largely spent most of last year being gated. So it's sold as something that provides daily liquidity and actually provides no liquidity. So that's clearly a fundamentally not fit for purpose structure. And we've also talked earlier on about how the larger REITs are a small part of the general stock market, and therefore they are inevitably subject to some of the noise that happens in the broader equity market. As a dedicated exchange just for real estate, but in a listed format, we think we're providing something that sits nicely between the two, that will be liquid and regulated, and yet will have less correlation to other markets. So it's, if nothing else, it's a new choice that wasn't there before. And just to obviously clarify as well, it gives people the opportunity to invest in a single asset, a single building on IPSX. Yeah, so you buy shares in a company, just like any of the large listed REITs, or indeed anything like NatWest or Vodafone. It's a company which is a UK PLC. It's often could be a REIT, and it'll list on our exchange, and you can buy and sell shares in the usual way. You could go to banks like RBC, that Charlie's Bank, and you could buy shares. The difference is, what's never been done before, and incidentally it's never been done anywhere in the world before, is that those companies are going to own just single buildings. That it follows they'll be quite big, these buildings. It won't be a house on Acacia Avenue that's getting listed, but they will be single buildings. And one of the things that follows from it being a listed company is that it will have a board of directors. It will publish periodic financial statements. It will have a red book valuation published every 6 months. It will, at the asset level, have a level of transparency that you simply don't get at the asset level in the larger REITs. Okay. It's a really interesting one, isn't it? And we're waiting to hear more on that as it comes forward. Charlie, it's just that broader question of what choices do investors have when thinking of what do you point to as the key areas people should be looking at when they're looking to access the sector?
Yeah, thanks. And I think I'll probably pick up a bit where Roger has left off and answer the question by providing a perspective on what appears to be working well and less well with regards to the performance of indirect vehicles, often in the public markets. And I think one of the differentiators has been strategy around a very focused approach to the underlying asset class that company will target, and its expertise at understanding the underlying operations of that asset class, and scaling as quickly as possible to access a lower cost of capital through financing, ultimately through to the debt capital markets, and so the REITs or listed PLCs that are doing well, and I would expect will continue to do well, I think have in common a very targeted strategy and a board and management team that have stuck to that strategy and avoided the temptations of scope creep. And those that are doing less well, and in some cases trading on quite big discounts to their net asset value, which can be a difficult place to escape from, have often been put in that position, I think, because they have had a diversified strategy that has either implicitly or explicitly meant it's very difficult to have that level of operational expertise with regards to the underlying asset class, to see the challenges that have been coming through people's living and working habits changing, and adapt accordingly. So, my shorter answer to that question would be, decide on the underlying asset class that you want exposure to based on how confident you feel in the secular trends that are going to continue to drive returns from that asset class, and then buying into the real estate exposure as a yield-led, inflation-hedged means of investment, should work out pretty well.
Okay, Noel, I'll come to you on that as well. Just quickly, what do you think are the key things to look out for when you're looking to access the sector? What options?
I haven't got much to add really, except in any business you invest in, or any opportunity you invest in, you're looking at the management team as to whether they've got the skills to deliver what they promise or hope to do. And real estate is no different to any other industry. There are sector skills which are very important to have in order to deliver that particular sector's returns. So it's all down to the people running the company or the fund or whatever the vehicle you go into, and due diligence on them. I personally love the idea of an investor being able to buy £1,000 worth of shares in a shopping centre down the road. He knows if he wants to, an office building two cities away, and a shed out in Park Royal, and he might have £4,000 in real estate, but he's bought what he wants, not what somebody else told him to have. Maybe that's because I'm a real estate guy. I quite like the ability, but I think that's democracy. A more democratic approach to investing. And years and years ago, when we were trying to get the enterprise zones going across the UK, and raising private investor capital to get into these zones to revitalise these areas. And one thing we funded, for instance, the Maryhill Centre in Dudley all these years ago. And people love to have an individual investment of £5,000 in something and go along and look at it. It was a tangibility of it all. And you don't think about those times, we were conned by the market so often into, I remember endowment policies. If you were 21 like I was, and you went out, to buy your first house, you had a life insurance, and with it came endowment. The life insurance for a 21-year-old is pretty cheap. The endowment policy was enormously expensive. It was a con. You were sold a savings plan, and if you left early, you were really penalised to leave the terminal bonus for the people who stayed in. It sounds like as a way that was terrible, and it's gone. Markets have to evolve to what people actually need, and people are more sophisticated now. And we saw through that. We saw through the endowment policy. We should be able to see through some of these other things we're being offered currently, which are not properly visible when we're investing.
Okay, just on touching on finally on REITs, as Roger mentioned, there's a sort of number of various reviews, it seems, of various things going on, and REITs being obviously the government looking into them. I mean, do you all feel they need to be more regulated or less, or is the general view just full stop, just to regulate things less? I guess just to get your sense of that. I don't know, Noel, what you think about that. I mean, should the government be getting more involved here and in regulation?
Regulation on the whole clogs things up. I mean, there's the rule of law, and you shouldn't break the law, but you should let people get on and work within the law. That's my view.
Okay, and Roger, I mean, in terms of this ongoing review that's happening at the moment, what do you think should come out of it?
Well, I think of the various different reviews, as we said. I think I mean, I don't think one thing I don't think is going to come out of it is less regulation.
Yeah. Okay. Now, we were speaking a while back about this coming up, Noel, and you said one thing to keep an eye on is, you know, we've already touched on, crucial is knowing which sectors are paying rent, who's paying rent in real estate, but also who needs what type of income, and exactly how you go about getting that as well. So I just wanted to drill a little bit more into that and just start with you, Noel. There, I mean, what should people be looking out for in terms of who's paying rent and who needs what type of income?
Well, the first thing is, you know, what stage of life you're at, and so on. So, you know, the best advice I was ever given is, you're young, buy some equities, because, you know, over 30 years they'll probably go up, and 40 years, and don't go too illiquid into things that are illiquid, because you might need the money, you know, before it's available to you. All those obvious points. I think that you know, there are different types of organizations which sort of run the world of finance. There are sort of trading operations, and they're enormous, you know, we see them all around us, and Canary Wharf and all the rest of it, who are necessary to make the markets work. And then there are longer term investors who take positions, and some of them want income and some of them want total return. Now, you know, I happen to sit in, one has one and one has the other. So the Pollen Estate, which is a large central London property holding, is basically an income generator.
Yeah.
We refurbish and we invest and all the rest of it, but we're basically income generator for what we call our beneficiaries, shareholders. And then something like the Henry Smith Charity, which I sit on, which is a charity. We're a long-term endowment. We're looking to maximise total return. And actually, you know, income isn't that relevant. We just sell something if we need the cash to give the grants. We give grants to the poorest in the UK. So, you know, we're looking to give away about 40 million this year. And it's not reliant on what income we receive. We just, you know, lighten up some of our holdings and some of the assets we've got, maybe real estate or shares or whatever it is. So it really, it depends on what, as an individual point of your life you're in, access savings or not enough savings and so on, and then what type of organisation you are. And I gave you two extremes there between income but you need that diversity of investors to so everybody's not heading for the door for the same reason at the same time, you know. So you'll satisfy somebody all the time and somebody not, probably.
Okay, but an important thing to bear in mind as well for everyone thinking about this. So I just want to ask you all about a few more things here. What data should investors be focused on when they're thinking about investing in real estate? I might come to Charlie first there and ask what should you be looking at?
Yeah, I don't think, and it's a great question, and I don't think there's the kind of silver bullet answer to you know, all of the data that you need for any particular situation always being in the same place. I mean, from an entirely personal perspective, you know, I think areas that any individual is particularly familiar with from the outset are a good place to start, and then the data around that you'll be more easily able to access and digest and interpret than areas that are completely new to you. And this, I think, comes back to that point of really understanding, you know, the operating exposure that you're buying into through owning the real estate in any situation. You know, I think, you know, the public markets are a great source of information. You get the kind of spot share price movements and associated dividend and implied yield, which you can, you know, cross-reference against the most recently reported NAV that people may or may not agree with, and that's a much bigger topic of conversation probably. But more importantly than that, I think the look through from the public markets that you get into the underlying trading of the portfolios through investor relations materials and analyst coverage, I think is hugely valuable. And that's always a kind of good place to start, I think, slightly under the heading of let's cheat and go and see where the market is pricing exposure to these different types of real estate. Also not forgetting any of the public bonds that are out there that you can check the pricing on as well.
All right. Roger, what data should you be people should be looking at here, listening in when they're looking to invest?
Well, I think, Charlie mentioned this earlier on, but I think perhaps the most interesting thing for real estate as an asset class in the last 12 months was that there was a period in sort of May and June last year when a lot of generalist investors just felt that commercial real estate was uninvestable. And they felt that because what they were reading in the newspaper was that the government had said, you don't need to honor those leases, you don't need to pay rent. I think, and it's been touched on, I think Noel was talking about this earlier on, that actually looking at who did pay rent and who didn't. And it's very interesting sometimes when you see, perhaps it's slightly counterintuitive, a lot of bigger tenants didn't pay rent because then themselves being listed, they were kind of under pressure from their investors not to, because brackets, they didn't have to. So where's all this going? I think, therefore, that probably the most important thing about whether your real estate investment is income producing or not is to focus on the credit strength, the covenant strength, the likelihood that they'll pay of the underlying tenants. Because if it doesn't pay rent according to the lease, it's not as valuable as you thought it was.
Yeah, and I mean, there's a really interesting topic there, and obviously we're going off on a tangent, but the government still hasn't said. I mean, there was a story, I think in the Sunday Times a couple of weeks ago, that the government was going to push out again the eviction moratorium, but I haven't seen any confirmation of that anywhere yet. But I mean, that stepping into the relationship there, I guess, did it have to happen, or do you think that just sort of caused irreparable damage for the traditional relationship between landlord and tenant? It's an interesting one, but I guess the government had no choice today. I'm not really interested to hear your view on that.
Well, I think it's fascinating because I've heard some really surprising responses when I talk to people about this.
Yeah.
A lot of landlords have thought it was absolutely the right thing to do to support their tenants, and I think a lot of it perhaps comes from the body language of if tenants were minded to pay but couldn't. That's different to if they could pay but didn't want to. And I think often that sort of starts the dynamic. But taking a step back from that, I do just question whether it's really right for the government to effectively transfer some of the burden of lockdown from one part of the private sector to another part of the private sector. I'm not sure the government should be doing that.
No, it's been a huge topic.
If I could add, I mean, some people have behaved shockingly, and they will be remembered. There'll be people that landlords won't want, and and I had this with the charity I've mentioned earlier, and we ran them up and said, we give money to the poorest 5% of people in the UK, and you can afford your rent, and you've been trading and you haven't paid it, and so 9 months outstanding, and eventually, against my better judgment, we gave them 1 month off and they paid up to date because they could afford it. But it's outrageous and it's just poor behaviour, and I wouldn't let them again. But they'll survive.
Yeah, I hadn't come to you there, and I'll just ask you about data. Is there something missed there that you think you really need to be looking for when you're looking at real estate?
Well, I'd say who tenants are, rent collection, it's become the new thing. Interest rates and leverage, I think, probably is another thing you should look at. I mean, I know a lot of people have come on, the wheels have come off under leverage in all of our careers, and what you've got it levered against, and what your rental relationships are, and when the exposures, the termination of the facilities occurs, and are they running towards it, and so on and so forth. And everything becomes a little bit difficult then if they've left it too late to refinance. So leverage isn't a bad thing. It's just got to manage it carefully, and you need to know what's happening in that company or that joint venture or that fund.
Okay. Now, with this sort of how looking at the sort of immediate world for real estate, what are the challenges, the key challenges you're looking at this year? And clearly, we're hopeful that the sort of message that things are really beginning to be opening up by summer carries on. But in terms of the pandemic, but just wanted to get your views on that, because I know we're moving towards the end of this. So it'd be great to hear from all of you what the challenges are for real estate this year. Yeah, Charlie, I guess come to you there.
Yeah, again, it's another kind of massive question.
Yes.
I think there is lots of real estate that doesn't have any challenges because it has proved to be performing extremely well by being invested in the right asset classes that were already pretty well established pre the government restrictions, following the health pandemic, and that pandemic having accelerated and amplified those themes, as opposed to, I think, really creating any new ones. And those asset classes that are doing well, could be categorized as anything to do with warehouses and anything to do with living. Will I suspect continue to do so. Where there have been asset classes that have been impacted negatively, retail being the best example. I think the challenge for those asset classes is based on reinstilling confidence that they will return to being investable, on the basis that customers' habits will have evolved, but still require stores in the right locations, in the right centres, with the right management team, with the right balance sheet to be able to operate effectively, and on a rental and lease basis that is sustainable, and therefore any investor into that can have confidence that the rent will be paid and the value fairly reflects that rent. And there's no original thought in that, I'm afraid. But it is going to take some working through and some trading history from the retail sector to establish what the new normal on a stabilized basis looks like. But it will, and I think once that has happened, it will return to being a very active investment asset class.
I mean, and just on that, how, in terms of telling the generalist investor about the nuances between the way particular retail landlords and groups are performing, I mean, is there other ways of telling that story as well that could be better done, I guess? I don't know, or is that not the case? It's just up to it. Everything's being done as it should. It's just going to come out as people see more information.
I think it will. I didn't catch all of the question, but I think it will. It sorts itself out, if I can describe it like that, as the restrictions lift and the habits of how people want to live and work and socialize, settle, post these lockdown restrictions and whatever we have to deal with in the future. I don't think there's any way of crystal ball gazing that, or indeed kind of fast forwarding through it. I think just kind of steady incremental progress.
Okay, and Noel, what are the big challenges this year you look out for?
Well, I think challenges, whether this year or in the next 3 years. I mean, one is clearly retail's changed forever in many ways from what it was before. It's our fault, as an industry. We spent a large chunk of my early career buying up little shops and turning them into very big shops because we wanted one big credit, and that would look very good in the sales brochure or in the portfolio. And actually, I don't think there are enough big shops around that want all the big shops that are available. So we've got to try and carve the shops up again. Much more asset management and so on and so forth. We've got to create a sense of place where places became everywhere looked the same. I mean, it was so dull. So you need local traders, artisan traders, and all the rest. We know all this stuff. So that's one thing that's really got to happen. The second thing, perhaps more controversially, is work from home. I think there's been a mismatch by the homes we've been making over the last 25, 30 years and what people might now need, which is open plan space is not great for work from home. And
yeah.
You know, we've all bought flats. We walked in. They said, "You can have a party here." And, oh yeah, I need a big room for a party, don't I? Or you know, I can have well, actually, if you've got two kids working, you're working from home. Two kids have been schooled at home. So people are going to spend quite a long time before they have open plan, I imagine. Or carefully think about it. And also some outside space. Again, we have given people balconies. I mean, you know, most of the continent there's a balcony in many flats and so on. So I think we've got the product wrong. We ought to get on and change that. And also, there's lots of things we can change our design, you know, in terms of more COVID next version of COVID friendly, so we don't have to actually interact and touch things as much. So I think there's quite a lot to do in that area in the next year, and perhaps a bit longer than that.
A bit longer than that.
Yeah, but I think the sheds are sheds, and they pretty well work, don't they? And offices, you know, the average size of office desk has shrunk in my lifetime by about half. I mean, it's probably the same. Paul's not as old as me, but you know, if you're a sitter desk now, it's smaller than it was when we started. That's for sure. We've been putting people closer and closer together, so the cost per desk will have to go up because more space is required. Therefore, there should be pressure on rents, because you know, why would people pay to have less people in the building the same amount of rent? So that's going to be an interesting conundrum, which the market's going to have to work out over the next 12 months, 18 months. People want more space. I suspect we'll end up with people wanting to come back into town. In towns, because they want society, they want the buzz, they want to go out for a drink in the evening, you know, they want to meet a new boyfriend or go to wherever it is, you know, you want society, and we can't all live in these pods and be thoughtful, generating people. So I think it will happen, but there'll be half as many of them in the office at any one time, and they want twice as much space, and that might have an effect on rents.
Yeah, no, absolutely, really interesting. And I was going to come to you, Roger. Oh, there's a question in here as well to ask you, probably to pick up on, Roger, before I then ask you what, you know, the big challenges you're looking at this year is, which is, we've had a question, given that retail investors can buy shares in REITs at a discount to NAV on the LSE, with the exception, it says, of those more focused on logistics, do you foresee difficulties around demand for securities on IPSX if those assets will trade at NAV?
That's a really interesting question, and it's one we've thought about a lot as we've sort of thought about creating this exchange. And I suppose to go straight to a fairly controversial sort of bombastic statement, I think NAV is irrelevant, and for lots of the reasons we've touched on throughout the course of the last 45 minutes or so, we're all agreeing that income is much more important. Income drives value. Income and the performance of the tenants paying rent is really what we should be focusing on. And indeed, we see this in other real estate markets around the world, where REITs trade on multiples of free cash flow. And by the way, we see it in every other sector of the listed market, where companies trade on multiples of earnings. And as people like Noel have said to me over the years, as I've been learning from them, you know, the focus on NAV is slightly odd, isn't it? Given that as the CEO of a property company or a REIT, the only number you can't control is the V, because that's what CBRE or Jones Lang tell you it is. You can control everything else in your business except that. So I think the focus on NAV is one that will change over time. But even then, and then picking up on something Charlie said earlier on, actually, the stock market is pretty good at figuring out what the assets are really worth. And it's not just logistics that trade at a premium, so does self-storage, medical property. In other words, all of the things that, again, we all agreed earlier on we thought were good places to invest. And it's things like retail and diversified, opaque, non-transparent companies, the things we all agreed were not good places to invest, that trade at a discount to NAV. So I wouldn't want to buy shares at a 40% discount to NAV today in the hope that that 40% discount closes through share price appreciation necessarily.
Okay, and then coming on to what you see as the structural challenges this year, the main ones you're focused on as well. next
Well, I
3
think
years, as Noel
the
said.
most interesting thing that's facing the industry over the next year is really just re-emphasizing something Noel said. I think the way the use of the office will change is going to be fascinating.
Yeah.
But there will be. I absolutely agree. People want to come back to work. There's hardly anybody I speak to who, unless they have a 10-acre garden and a swimming pool and a tennis court down in Surrey, everybody else wants to come back to work. What will those offices need to look like? They're going to have to change. I also think, we're obviously assuming that the vaccine rollout continues, is successful, cuts transmission rates. But again, I think we're probably all fairly reluctant to get on the 7:23 from Woking in the morning at the moment and have to stand face to face with each other. So we need the vaccine to work, but assuming it does, then I think how the office configuration changes is the biggest thing that owners of offices must be worrying about at the moment.
Absolutely. Well, that's been a great debate. Thank you very much, and yeah, thanks to the audience for joining as well. I just need to mention that this webinar has been recorded, and the link will be shared with all registered attendees to listen in. So on that note, thank you all very much.
Thank you. Bye-bye.
Thanks, Paul.